The market has expected the RBI to raise interest rates by 25 basis points, but RBI surprised the market by announcing a pause in the interest rate hikes. On April 6th, the RBI decided to keep the interest rate unchanged at 6.5%. Interest rates always seem to make people feel a little confused, but interest rates are just so important that when the interest rate moves, everything moves. Although it is somewhat exaggerated, but it does express the importance to the economy. So, what impact do interest rates have on the economy? In order to understand how interest rates interact with the economy, we need to understand credit first. Credit is the most important part of the economy and probably the least understood. When borrowers promise to repay and lenders believe them, credit is created. Any two people can agree to create credit out of a thin air. So, let's understand why is credit so important. Because when a borrower receives credit, he is able to increase his spending. And remember, spending drives the economy. This is because one person's spending is another person's income. So when you spend more, someone else earns more. When someone's income rises, it makes lenders more willing to lend him money because now he is more worthy of the credit. So increased income allows increased borrowing, which further allows increased spending. And this pattern leads to economic growth. As economic activity increases, we see an expansion. Spending continues to increase and prices start to rise. This happens because the increase in spending is fueled by the credit concept. When the amount of spending and income grows faster than the production of goods, prices of the goods and services start rising. And when prices rise, we call this inflation. The central bank doesn't want too much inflation because it can cause problems. And looking to the price rise, it raises the interest rates. With the higher interest rates, fewer people can afford to borrow money, and the cost of existing debts rises. Think about this as the monthly payments on your credit card going up. Because people borrow less and have higher debt repayments, they have less money left over to spend. So, the spending slows down. When people spend less, prices go down. We call this deflation. And because now economic activity decreases, and that's why we have a recession. If the recession becomes too severe and inflation is no longer a problem, the central bank will start lowering down the interest rates to let everything to pick up again. With lower interest rates, debt repayments are reduced and borrowing and spending automatically picks up. And we see another expansion. Now you can see the economy works like a machine. In the credit debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credits. When credit is easily available, there's an economic expansion. When credit isn't easily available, then there is a recession. And note that this cycle is controlled primarily by the central bank with interest rates. So, I believe till now you might have understand this is how interest rates or central banks affects the whole economy. Interest rates and stock tend to move in opposite directions, and the stock market reacts quickly to the interest rate changes. That's because it affects investors' expectation about future stock performance. For example, if the interest rate rises, there will be a higher cost of borrowing for the businesses, including higher payments on current debt. The altered repayment plan will mean that there's less profit on the books and ultimately the share prices could fall. The converse is also true. Another reason is that as bonds typically carry less risk than stocks and now offer higher returns due to increased interest rates, this new risk-reward profile becomes more attractive to the investors, and they substitute stocks to bonds. The opposite is also true. When interest rate goes down, bond prices rise. As bond prices go up, stock prices will seem more attractive because investors will have more money to spend. Note that growth stock performance typically is more sensitive to interest rate than value stocks. Mostly, bonds and interest rates have an inverse relationship. When the interest rate goes up, bond prices typically go down. And when interest rates goes down, bond prices typically rises. This is a fundamental principle of bond investing. The relationship between interest rates and bond prices can be a little confusing. So let's understand why do they move in an opposite way. After a bond is issued, it can be traded in the secondary market, causing the bond prices to fluctuate depending upon the demand and the supply, and mostly on the changes in the interest rates. When the interest rate rises, existing bonds paying lower interest rates become less attractive, causing their price to drop below their initial par value in the secondary market. But the coupon payments remain unaffected. When the bond prices drops, its yield increases, making it competitive against newer bonds paying higher rates. When interest rate falls, the coupon on the bond is more attractive than current market rates. So investors would be willing to pay a premium above the par value for that particular bond. That's why bond prices rise. In short, bond prices and bond yields move in opposite directions.